Economies, sectors and stocks set to outperform on the global stage. Register now at ausbiz.co/goingglobal. Going Global is thanks to Value 3, where value investing meets the future and wins. Sign up now to get Mark's Value 3 Insider at value3.com.
Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us. Well, first, let's get to some breaking news. US President Donald Trump just announcing a trade deal with Japan that he said will see Japan investing $550 billion into the United States and paying a 15% reciprocal tariff. He said that Japan will be open to trade for cars, trucks, rice and certain agricultural products, among other items. Well, it was actually a mixed day of fortunes for global markets, with European shares weighed down by disappointing earnings and anxiety over the lack of progress in US trade negotiations. On Wall Street, the Dow gained while the Nasdaq lost ground, and the S&P 500 edging higher to reach another record high ahead of highly anticipated earnings results from Alphabet and Tesla due tomorrow. Shares in carmaker GM tumbled after it reported a $1 billion hit from tariffs to its quarterly results, fueling investor concern about the Trump administration's global trade policy. GM's second quarter core profit falling 32% to $3 billion. Shares of rival Ford also falling. Alphabet and Tesla climbed a day before their quarterly results. Among the other big tech stocks, Meta and Microsoft lost ground. Shares of RTX dropped after the aerospace and defence giant suffered from tariffs despite strong demand for its engines. Lockheed Martin shares tumbled after its quarterly profit plunged by around 80%. Philip Morris slumped after reporting second quarter revenue below expectations, and Coke's quarterly estimates beat expectations, boosted by higher prices, even as volumes dropped in key markets. And oilfield services company Halliburton forecast a sharp decline in full-year revenue after posting a 33% fall in profit for the second quarter due to softer than expected demand. Well, the latest US data shows the Philadelphia Fed non-manufacturing index improved but remained in contraction, up from negative 25 to negative 10, while the Richmond Fed manufacturing index fell from -8 to -20, a 10-month low. Meanwhile, US Treasury Secretary Scott Bessent said he will meet his Chinese counterpart next week in Sweden to discuss what is anticipated to be an extension of an August 12th deadline for a deal to avert sharply higher tariffs. The worst case scenario is that tariffs on Chinese exports to the US snap back to 145% and 125% on US exports to China. Meanwhile, Scott Bessent has said there's no reason for the Federal Reserve Chair to step down, saying there's nothing that tells me that he should step down right now. His term ends in May. If he wants to see that through, I think he should. If he wants to leave early, I think he should. Well, this is despite President Trump again criticising Jerome Powell for not cutting interest rates, which saw US Treasury yields slip further. The 10-year fell to 4.33%, the 2-year down to 3.83%, and the US dollar continuing its slide, particularly against the yen, although that'll be on watch now given that deal that's just been announced. And the Aussie dollar climbing back to 65.5 US cents. Bitcoin, it is close to, well, in fact, right on 120,000 US dollars. Oil prices, they've fallen for a third consecutive session as hopes fade of a trade deal between the US and Europe, stoking fears of an economic slowdown in the world's largest oil market. Brent crude futures were down more than 1% to $68 a barrel. Copper was up around 1.5%. Iron ore price has continued to rally, up close to 2% to $104 a tonne, and gold extending recent gains, drawing on strength from trade uncertainty and a weaker US dollar. And bond yields, spot gold at $3,430 an ounce. Let's take a look closely now what's going on with US markets. Howard Silverblatt joining us from S&P Dow Jones Indices. Howard, welcome back. Good to see you. Let's first start with those movements we've seen on the broader indices there, with the S&P hitting another record. This is despite what we're seeing with trade policy, obviously concerns about the Fed independence, whether in fact they're going to cut or not. What are you watching?
We're watching the same items everyone else is, and we have a little bit of optimism is growing here. It's pretty strong on the street. Obviously, we've had another high today. The market's holding its own, but every point it goes up, it could set a new high. The market's moved beyond the tariffs at this situation, and we're starting to be able to quantify some of the costs for them. Inflation, PPI, CPI numbers, and the earnings. You mentioned a couple like General Motors and some Ford, how much they're absorbing in there. We're seeing that companies are initially absorbing more of the tariffs than they're passing on to customers, trying to protect their sales. Also trying to play the short game here that the tariffs will fix themselves up. I should note a lot of companies got a lot of products ahead of time, or that trade that came in prior to the tariffs. So the full impact on the company's margins haven't been seen. But we're definitely watching that. The Japanese 15%, we have to see what the details are. There's a lot to be worked out on there, but that's important. We still have India to go, in the EU, which are major, and Korea. In general, we think that the August date will be pushed forward, but a couple of countries will probably be hit with tariffs. The big one still remains China, and they are going to meet next week, the US and China. We think that the date will be pushed out there. That's going to be complex, but the other ones are starting to fall in. Still a lot to go, but we're getting pieces, and that's why the street's more optimistic. Earnings are coming in very well. We've got that 18% in there. The number's 8.5% over last year. We're setting a record. And third and fourth quarter, while margins are expected to decline somewhat, the earnings are still expected to set a new record. So the economy is good. We're making money, not as much as we want, but we're making money, and the employment numbers are good. And the market keeps going up on there. We are paying for it, though. The PEs are very high at this point in time.
Well, just in terms of those earnings, and particularly the impact of tariffs, Howard, which you pointed to there, what are we hearing from companies in their ability to absorb those costs? What's the capacity there to the point where they will be forced to pass them on to consumers?
Yeah, that's what we're quantifying too. They've absorbed more initially, but how long can that run rate go if they're burning through cash on there? At this point in time, if the tariffs start to even out, they should be able to absorb the initial part, but it's definitely going to hit the customers eventually. Somebody has to pay it. The companies can only absorb so much. In the guidance, they're still dancing, but we're getting a little bit more details about lower margins in general. Again, we only have 18%, and a lot of those are the financials, which react differently. But most of them are looking for lower margins going forward, especially in the second half, but they're holding out for next year. The one big beautiful bill that passed has a lot of pluses for the consumer starting in 2026 via taxes, withholding, and credits. So it looks, they're trying to see that there'll be a boom in the economy, spending from individuals going up, not necessarily enterprise and corporations, but individuals. And if the consumers could start to increase their spending in Q1, you just have to kind of hold on Q3 and 4 where we are now.
Howard, might just go to earnings thus far. In fact, we'll bring up a chart in terms of those hits and misses we're seeing sector by sector. What are you noticing there?
I'm noticing about 78% of them beat. Historically, it's like 62, 63. And those financials, by the way, 25 out of 30, those are large beats. Financials are about 23% of earnings in there. They're second only to technology. So they are a major component in there. What we're also looking for now, the industrials, again, 15 out of 16. Again, this is just the opening bid here. We have 91 issues, another 400 to go. But those companies are doing well and they're holding their own. Their margins slightly declined, but still in the nice double-digit range. So earnings, again, are holding up. Sales have increased. We're not at the record, but these earnings this quarter are going to be a record at this point in time. So we're in a good position to absorb costs.
Howard, just turning to the Fed, we're in that blackout ahead of the next meeting, of course, but what are your expectations? Because, I mean, the market seems fairly sanguine about this, that as to whether there's going to be a rate cut. Obviously, not one expected forthcoming. Nonetheless, that pressure is continuing on the board, and in particular, Jerome Powell. And we have, for instance, we've heard from Christopher Waller as well, clearly, who's saying, look, he's prepared to dissent.
Yeah, the vote will be important. I mean, as far as next week's meeting, very few expect any kind of change at this point in time. It will be a shock to the market on it. It's not going to have the vote. September, yes, and probably in December. The pressure on Powell is considerable. I've never seen anything like it at this point. But a lot of the street, including myself, think that the goal here is not to get him to quit, but to leave when his Fed chairmanship is up in May of 2026. So that's only less than a year away from now. He is still a member of the governing board, so he gets a vote. He's one of the 12 votes until January 2028. That's 2 years from now. So we believe that the goal of President Trump is to get him to leave then. So that gives him another position and doesn't keep him along. If Powell stays on, he's going to be there for another 2 years. Yes, he could be a punching bag for Trump, but that's one vote that he's not going to be able to influence or get.
Howard, great to get across what you are seeing, particularly on Wall Street. Thanks for joining us from S&P Dow Jones Indices.
Thank you.
All right, let's return to the local market just ahead of our open here. As we get going, looking for a positive start. SPI futures up a healthy 0.4 or close to 0.5% higher. And once again, the focus likely to be on those iron ore miners, with the iron ore price continuing to rally at this point. Stay with us. We'll get right across that in just a couple of minutes' time.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.